Hello everyone, good evening. Today we will discuss a company called Data Patterns Limited. It was requested by a viewer of the channel. Preliminary analysis tells me that it's a fantastic business, growing healthily at 25-30%, excellent gross margins of close to 60%, and excellent PAT margins of over 35% consistently. As a business, it's a fantastic business. But is it a good investment? That is the question which we'll try to answer here. In this video, we will cover the business model of the company, the sectors it operates in, an overview of those sectors, the product portfolio and the revenue split, details of the manufacturing facility, its credit rating, a quick financial analysis of the company. Um, During my research, I came across one very interesting point which I would like to share, the potential risks which the business faces. And at the end of it, we will have an overall summary of the analysis as well as my conclusion on whether it's a good investment or not. So, without much ado, let's quickly get into it. So, Data Patterns India Limited is one of the fastest growing companies in the defense and aerospace electronics space in the country. It's among the few vertically integrated defense and aerospace electronic solution providers, and it caters primarily to indigenously developed defense products like the Tejas BrahMos missile, which was developed, and so on and so forth. It's in the business for about 35 years, and it offers solutions across the spectrum of defense products like space, air, land, and sea, and undersea also. It has those design capabilities across the entire spectrum of strategic aerospace and defense electronics solutions, including, designing processors, radio frequency microwave equipment, embedded software, firmware, and mechanical engineering. Its product portfolio includes radars, underwater electronics, communications, and other systems, electronic warfare suite, BrahMos program, which is a very specialized program, avionics, small satellites, and ATE for defense and aerospace systems. The company believes in working in a building block module system wherein it builds blocks which can be just picked up off the shelf and can be used on multiple end systems. So it's trying to, structure its business just like Lego. You just pick up the pieces and build what you want to do. Key customers, of course, being in defense and space, the key customers is primarily Indian government, which accounts for the bulk of the revenue today. Now, when I say government, I mean either it is the direct defense agencies like DRDO, ISRO, and so on and so forth, or it is the government PSUs and private sector defense companies, which in turn depend on the government. So that covers the business model more or less. To summarize, it is into the defense and aerospace electronics sector, and it is one of the few very focused and vertically integrated players within the space. Now that we have covered the business model, let's quickly cover the sectors as such, the defense sector as well as the space sector. So, without getting into too much details, let's quickly get into the data for the last 10 years. The government spent for the last 10-11 years, both on the defense sector and the space sector, is in the public domain. So, what we will try and do is simply pick out the data, see how the government spending is increasing in that space, and obviously, a small portion of that spending becomes the total addressable market for data patterns, simply because it's only in one small subsegment of electronics within the entire gamut of defense spending. In 2013, the defense spending as per the Government of India statistics was 2 lakh 3,000 crores, which in 2024 has gone up to 5,93,000 crores. This gives me a CAGR of 10.2% over the last 11 years. Similarly, space spending in 2013 was a spend of 5,600 crores against a 2024 budgeted spend of 12,500 crores. This gives me a CAGR of 7.6%. If I simply do a simple addition, total defense plus space spending from 2013 to 2024 grew from a 2,09,000 crore number to a 6,06,000 crore number, giving me a combined CAGR of 10.15%. So out of this 6,06,000 crore total budget as of 2024, GOI budget as of 2024 for space and defense put together, I believe the TAM for the addressable market for data pattern will be not more than 5 to 6%. So that gives me a total market size of 30,300 crores, growing at a 10% annual CAGR rate. 2024 data patterns revenue was 520 crores, which gives me a approximate market share of 1.7%. This does leave me with ample space to grow. If I look at data patterns revenue CAGR over the last 10 years, it is close to 24%. So yes, it is growing much faster than the overall TAM, but at the same time, the management is saying that it will be able to sustain this growth of 24-25% over the next 3 to 5 years time. Market is growing. Data patterns has a very small market share, and in turn it will grow as the government focuses more and more on domestic consumption. So that is as far as the market size is there. Now, one thing you must notice that this is only the government of India spending on the defense and aerospace sectors. But there is an opportunity of exports. There is an opportunity of private space enterprises. Defense, of course, there can be no private enterprise as such because the end customer is the government. But there can be export opportunities there. So overall, the market itself is not 30,000 crore. It will be much bigger when I look at it at a worldwide level. Can there be more opportunities to explore, and can that be also a avenue to sustain growth? Well, I definitely think so. Now let's quickly have a look at the product portfolio of data patterns as well as the revenue split. The product wise sales for Q4 FY24 was electronic warfare suit was 26%, radars were another 28%, avionics 28%, and others were 18%. So there is a healthy mix of products with no real dependency on any one of them. Plus also my product development is dependent on what government of India wants me to develop. So I believe there will not be any issue in terms of an overall dependency on one particular product. The product diversification is there. The revenue split, if I look at it, production, which is hardware, was 54% of my revenues, wherein I'm actually giving out products, which can be electronic equipments and so on and so forth. Development is 42%, wherein I am developing very, very specific applications and for the government. And services, which is maintaining the existing hardware already supplied, is another 4%. Revenue split also is pretty well diversified between hardware and software as such. For manufacturing, the company has a 2 lakh square feet facility on a 10-acre land in Chennai. I believe since it's mostly into hardware, electronics and hardware, that is more than ample space for the at least next 3, 4, 5 years of revenue expansion. Now let's quickly have a look at the credit rating of the company before we dive into the financials. The company is rated A by ICRA as of July 12, 2024. The overall limits rated were 750 crores, but most of it were non-fund based limits. If we consider the fund based limits, then on a net of cash basis, the company is debt free today. However, two points were noted by the credit rating agency wherein it elaborated on the challenges faced by the company. The first one was the high working capital intensive nature of operations, both because government receivables are normally stretched over 6 to 8 months. Once you bill, the government tests the product and gets final okay from its various levels, and then the payment is released. So it takes anywhere between 6 to 8 months for the money to be collected once the product is shipped out. And two, the long gestation period of the product development itself. That means to develop a product and to ensure that it becomes deliverable and in a selling state, I have to keep inventory levels at least of a year, year and a half at any point of time with me. So those two periods, those two challenges are something which was specifically mentioned in the credit rating, credit report of the company. The high working capital intensity. The rating agency used a ratio called net working capital upon operating income, which was as high as 84%. That means if the company is doing a revenue of 520 crores in 2024, then its working capital requirement was 84% of its revenue, which is close to 460 crores. Now that is real working capital intense operations. Before we get into financial analysis, I would like to point out one very interesting thing. When I was reading through the transcripts, I got to know that data patterns is audited not only by its financial auditor, income tax authorities, GST, the quality auditors, but also the IB audits the company. Since it's a IP company, since it's a electronics manufacturer and it makes its own software and it's very related to defense and space, very sensitive topics. If somebody steals the data, then it is of immense value to others, because they will then know how to make counter effective products for any kind of defense products, missiles. For example, BrahMos missile, if somebody knows the software behind BrahMos missile, they can develop a counter to it. So in addition to their regular firewall audits and electronic audits and their data security systems which the company maintains on its own, there is also an IB audit on top of it. So that is a very interesting point which I read and I thought I'll share with you. Now let's quickly get into financial analysis of the company. As I told earlier, the company is doing very well. It is growing its revenue by approximately 24-25% year on year, and the management is predicting that the growth will continue at that same pace. 2024 revenues were 520 crores. Gross margins were 68%, EBITDA margins were 43%, and the PAT margins were close to 35%. Those are fantastic numbers by for any company whatsoever. As far as debt is concerned, if I leave out the non-fund limits, which are the bank guarantees, it's a zero debt company net of the cash balances. There are, however, a few points which really bother me in this particular set of financials. One is the very high debtor days. As per the presentation shared by the management, FY24 saw a debtor days at 280 days level. That means once I raise a bill, I get my money in the ninth month, not before that. It has consistently remained very high, as can be seen from the chart here. Similarly, inventory days as per the management is 187 days in 2024, which is again 6 months of inventory. So it has to have 6 months of inventory, and at any point of time it gets its realization, money realization, in 9 months from the day it bills. So if I add both of them together, it becomes a period of 15 months. Creditors are more or less in line with industry at 30 days. So that gives me a cash conversion cycle of 14 months. That means for doing a 100 rupee revenue, right, annually, I need to have 120 rupees, 115 rupees as working capital deployed at any point of time. That's an extremely large number. And honestly, what this number does in terms of this high a cash conversion cycle does is that it limits the growth potential that I have. So my revenue growth will always be subdued because of this high working capital intensity. Now, this really was a worrisome factor. This is partly offset by the excellent margins they have, no doubt about it. Gross margin of 72% or anything above 65% is fantastic. And also, the fact remains that government debtors are normally safe. They're not really, they might get delayed, but in the end, one does get paid. Financials as such are fantastic, except for the high working capital intensity part. So, now let's get into the potential risks which I foresee that the business is facing. Of course, two risks were already enumerated in the credit report. One is the high working capital intensity, which limits the kind of growth which I can have. And two is the delay in project execution and offtake by the customer, because it is dependent on government of India for the projects to move on smoothly. So projects can get delayed, change of government may affect my projects, and so on and so forth. But one more risk which I honestly see in this business, which the credit report did not really bring out, is that even though it is in a very sensitive sector of defense and aerospace, the projects are still allocated through competitive bidding mode. Now, when your business model is such that to acquire business you have to bid for it, that essentially squeezes the margin every single time. Now, as more and more players get into this space, as more and more players get eligible to bid, as more and more players in the defense sector do forward and backward integration and start getting into the territory occupied by data patterns. For example, an L&T might want to get into the same business which data pattern is and start bidding for it again. It's already empaneled with DRDO. A Mahindra Defense is already empaneled with DRDO. They are currently producing vehicles and defense systems and physical guns and so on and so forth. But the day they decide to get into software as such, electronics as such, that is the day competition will increase, and that is the day the margins will start getting squeezed day in day out. Yes, they have a head start. For somebody else to get into a BrahMos missile program will be very, very difficult. But this is one inherent weakness in any business model, where the primary mode of acquiring new business is through a competitive bidding mode, that your margins over a period of time come down. So these are the three major issues which are there. I don't see any other issue as such. So overall, if we do a quick summary, the business model is good, the sector it operates in is growing, and the company itself is growing faster than the sector. There is ample room and scope to grow for the company at this point of time. The company is not dependent on one particular product as such. It has a decent mix of product and services offered. The manufacturing facility is not a bottleneck. It has ample space to grow for at least next 3, 4, 5 years. The financials are excellent. The credit rating is very good. And overall, it's a fantastic company. But what is the conclusion? Is this an investment option to be considered at this point of time? All investors, all marquee investors, be it Warren Buffett or be it Rakesh Jhunjhunwala, always said it's good to buy great companies at fair prices. But if you pay absolute bonkers of a price for a great company, then you will not really make any money. So let's do a quick number analysis here. The way I see this is, the company is projecting a revenue growth of 20 to 25%. Let's assume 25% for the time being, that the company will grow at a CAGR of 25%. Let's assume that the company will maintain a PAT of 35%, which according to me will be difficult. Over a period of time, the margins normally come down. Then these are the numbers which I get for the next 5 years. Now the assumptions are absolutely basic. So these are the kind of numbers which I get. In 2028, for example, I get a turnover estimate of 1200 crores, up from 520 crore today, and a PAT of 440 crores. The interesting part now is, what kind of multiple will you assign to this kind of a business? According to me, any business, no matter how good it is, I'll be very comfortable buying that business at a multiple which is more or less equal to its PAT percentage. I will not really want to give it any further multiple if it is a growing company. So if it is making a 35% PAT, I'll be very happy assigning a multiple of 35 to it. Using this logic, the market cap of the company at in 2028 will be close to 15,000 crores. Now, what is the market cap of the company today? It's 13,800 crores. So we can see already that at least the next 4.5 years growth is already built into the pricing today. It's fantastic business, no doubt. But my objective here is to make money on my investment. Do I see this stock going up in the next 4 years by 50, 60, by 20% CAGR at least? Not really. If it grows at 20% CAGR from here, then the market cap of the company should be close to 30,000 crore by that point of time. But I don't see the multiple sustaining. My conclusion, and again, this is not an investment advice. Please do not invest basis this video. Please do your own research and reach your own conclusions. Is that yes, it's a fantastic business, but in today's pricing, in today's value the market is assigning to data patterns today, it's not a great investment opportunity. Until next time, have a great evening.